In this video, I want to talk about something that I have a discussion on a pretty regular basis, and it's a particular situation that I used to find myself in when I first started trading, and it was all about different time frames. So, what time frame is the best for you to be trading off of? And I see that question a lot on social media. I see it on blogs, videos on YouTube. They talk about what's the best time frame, and sometimes they'll talk about the time frame that they like trading off of, but what I found in the first year or two of my trading career is that the time frame that I'm trading off of may not be the best time frame on that particular day. And let me give you a quick example of what I mean. And I have this conversation all the time when coaching students will ask. They'll say, what's a good time frame for me to use? And then the first question is, well, how much time do you have to trade, right? So we talk about this quite a bit, where if you are working full-time, if you're putting in 40, 50, 60 hours a week or more, you're operating a full-time business or you've got a full-time job, you're going to have a limited amount of time. So you probably couldn't really day trade all that effectively and sit and babysit some of these trades or watch, like, let's say, a 5-minute candlestick or bar chart to try to fire off some trades and scalp. Everybody's got a little different opinion about what scalping is, but for me, for the most part, scalping is not only just a matter of getting in and getting out really fast, but it's also really short-term profits. And very often, a lot of those scalping strategies don't even have like a precise entry. I mean, you can develop them, of course, but what I'm getting at is these are just like generalities, right? We're just talking about general terms of what's good, what's bad versus something else that somebody else might be doing. So the first thing you got to remember is that what I'm doing, for example, it may not suit the way you trade. So you might have to adjust the time frame. And when I would sit down in the first year of my trading career, I was trading the futures, and I was also trading Forex. So I would trade off of really small time frames, and I would scalp. And I would sit, let's say, for example, and I would look at a 5-minute bar chart or a candlestick chart, and I would just look for trades, and I wouldn't change the time frame at all. I would just sit there and continue to look at that 5-minute chart. And occasionally, I might start off my day where I was looking at the daily time frame initially in the beginning, but I really didn't design a trading plan around what I saw. And very often, each day, at the close of each day, it's not guaranteed that you're going to get some kind of a signal. You may have to wait a few days until price moves around, because what we're looking at right now, this could be a daily time frame, which it is not. But you get my point. If we're like in the middle of a trend, you're going to have to find some kind of an opportunity to get in on a pullback or something like that, or watch for an area of reaccumulation. That might be a better entry. Or you simply wait for price to run into like a critical level of resistance or support, and you can trade the bounce, or you trade a breakout again, something to that effect. But what I found was that, again, the time frame that I'm using at that particular moment may not be the most effective time frame on that particular day. So what I suggest, and what I always do myself, is start looking around on different time frames. We're looking at a 30-minute chart. So I'll show you, this is a perfect example of what I'm talking about when I say this on a pretty regular basis. So let's just say, for example, I was just trading only off of the 30-minute time frame, and I wasn't looking at anything else. Well, you probably know, if you've watched a lot of my videos, that I do things a little bit different than what you might see in a lot of other YouTube videos. Sometimes YouTube videos are talking about just simple moving averages and then some indicators down here at the bottom, and that might give them a trend, an opportunity to take a trade, or a trend line break. They'll put in a small short-term trend line break, and sometimes they'll work and sometimes they don't. So what we're looking for is we're trying to identify where smart money is stepping into the market. We know that when we trade alongside with smart money, we're likely to see a more reliable trade, but we're likely to see a more accelerated move. So let's say it was a move to the downside, and this was an area of distribution. If we're trading alongside with smart money, we're likely to get in at a time where we see that move, similar to what we saw over here last week. Now, we talked about this trade here and this range of consolidation. I actually made a video about this one as well. So again, we were tracking the footprint and the behavior of smart money, and we realize exactly when to get in, and it's usually a move that moves this fast. I mean, it's pretty accurate. When we see price moving inside a consolidation, it's hard to gauge who's trading, what phase it's at. So what we also want to do is analyze the phases of consolidation, because that also helps us determine when we should be in the trade and when we should stay out. So again, things aren't really lining up too well here as I sit down to start looking at this 30-minute bar chart. So if I'm looking to track the footprint of smart money, there's certain signals and certain things that I want to see with these bars, the ranges, the volume, the up thrusts that sort of fail and then they come back down inside a consolidation. Sometimes that's all that it takes. Sometimes that's all you get. So what I'm getting at is, let me go over here and expand this and you'll see exactly what I'm talking about. So if you look at this area of resistance right here, let's again say that I'm just looking at the 30-minute. I don't look at the 1 hour. I don't look at the daily or anything else. And I'm just sitting down to try to fire off a trade. And again, this is a mistake. It's a real simple mistake to get into, or a habit that you could fall into. And I did it. And I had to break myself of this habit. So you'll notice that this candle right here, this bearish candle, sort of closes flat, right? It kind of closes about the same level that it opened. And there was a little activity here. This is prior to the London session or the New York session. So we would expect it to be a little slower here. You can see here with volume that there was a little more activity here on that bar, like 30-minute bar, and it made an attempt to try to take out that high, but it didn't close above that high. And then the next candle, it does the same thing. A little more volume, not as much as the bearish volume that you see right here, the bearish bar, but this one closes bullish and closes above and outside of that range. Now, if you're not aware of how accumulation or distribution is created and how smart money moves around, if you're not aware of those concepts and those principles, and you don't know how to see the footprint of smart money on the chart, if you can't determine that, then you might be likely to consider this trade right here, this candle or this bar, which closed above resistance, as a possible buy opportunity. It is very possible. And there was, I know that a lot of people, they draw trend lines everywhere, and they have this little idea that they can trade trend line breaks all day long and make a lot of money. And again, sometimes they work and sometimes they do not work. And there's also the issue, where do you take profits? Even if they do work, you've got to figure out where you're going to take profits. Usually they're going to take profits right around that level, or maybe manage it and see if it pops through. Again, this was a candle or a bar that actually closed above that resistance. So that could have been considered a possible buy opportunity. Some people would actually look at that and say, well, it looks like it's going to go higher. So we're going to go right there. And I know this because I used to make this mistake. And I actually joined a chat room in the first year of my career, and they would call out trades whenever price would take out a high or a low, and they would immediately just say, buy pound dollar when it would take out the high. And then a little while later, it would come back down inside a consolidation, and I'd get stopped out. They didn't give us really targets. Sometimes maybe a few minutes later, they would give us a target, but of course it was already over with, or they would say that they would scalp, and they weren't really telling anybody. They were always trying to cover themselves, right? They were making serious mistakes, and they weren't capable. They didn't have the skill or the ability to read everything that I just described, analyzing consolidation, the different phases, tracking the footprint of smart money, and knowing when to get in and when to stay out of the market. So again, this could be considered bullish. So I'm going somewhere with this. Give me just a moment. I'll try to speed it up here. So at this point, what we have is a candle that closes above that resistance. And if I wasn't looking at a larger time frame, I might miss more information. Like, I need more information before I make some kind of a decision. Now, I know what's going on here, so I wouldn't chase this. I wouldn't think that this was actually a bullish move. I would be looking for an up thrust that would fail and likely come back down inside a consolidation, and possibly, very, very possibly, let's say as the day unfolds or we move into another trading session, it could be a reversal and there could be a markdown phase. It's a very possibility. It's a strong possibility. So what I'm going to do here is switch to a 1 hour chart, and we're going to see how different things look with the bars in relation to this critical level of resistance. So let's change this, and then I'm going to expand it so you can take a look at what's going on. And now you can see by just simply going to the 1 hour chart that none of these candles have closed above that resistance level. So now this starts to confirm the fact that, number one, I shouldn't chase this. I shouldn't try and trade this any higher. It's not really providing a signal. And the 1 hour time frame for day trading, even for day trading purposes, I have found throughout the entire course of my trading career that the 1 hour time frame is a very effective time frame that will give you a pretty good idea of what's going on as far as consolidation. If we're really seeing a breakout of consolidation, there's a lot of things going on there on that 1 hour time frame. Now, what I'm saying right now may not be the case during the London or the New York session. It's very possible that the market could be reacting a lot better on a 30-minute time frame. So things, the way they look right here on the 1 hour chart, they could actually look really structured on a 30-minute time frame. And then at that point, I've determined that it's very likely that that's what most of the market is trading off of as far as that day trade opportunity. We're not talking about the people that, like they're investors and they're looking at the weekly and the monthly and the daily time frame, and they're not even looking at the charts with all of this activity here. We're talking about the day traders. So sometimes you'll notice that if you're trading off of one particular time frame, let's say the 5 minute, and things look really choppy and they're just not really you're not really too comfortable. You can't tell if it's really a serious low that you can trade a bounce off of, or a very confirmed high that you can trade a bounce and a pullback. When you see things that just aren't lining up very clear, go up one time frame. So if it was a 5-minute, I would recommend a 15, probably or preferably a 30-minute. That's what I would do. I would go from a 5-minute to a 30-minute. And then if the 30 minutes still looked a little bit choppy, and even just to give it a final test, just to make sure, I would go to the 1 hour chart. And then when I go to the 1 hour chart, again, you can see just how obvious it starts to look here that there's really no reason for me to go long just yet. It's not to say that it won't break out and it won't give me a signal to go long. It could. It could also give me a signal to go short at some time. I've got to continue to watch. I need more data. This is not an opportunity for me to get into the trade. If I was analyzing the phases of consolidation, this isn't a phase or a move where it started to push through resistance. This is not taking place in a phase that I would actually consider executing trades. So I still have some time to wait. But what I'm getting at is that, again, if you don't understand these concepts of the different phases of consolidation, how to track and follow and trade alongside with smart money throughout this process of either reaccumulation and then possibly a breakout to the upside, or distribution where price could potentially come right back down again. If you don't know how to read that, then you're left to just reading the candles or the bars. And again, if you're looking at the wrong time frame, or let's say if you're looking at one time frame and it's not enough information, and you take a trade off of that, like we saw on the 30-minute where it closed above that resistance, the next candle, it could have gone up maybe a pip or two higher, or a point or two higher than that 30-minute bar, and then dropped back down. We see that pattern happen quite a bit. It didn't happen today, but we see it happen quite a bit, and it would have been tempting to try and trade that a little bit higher if you were not aware of how to read the consolidation and the phases of consolidation. That's what I'm getting at. So this is a perfect example. I talk about this quite a bit, and I get the question a lot, like what's the right time frame? And again, it really depends, number one, on how much time you have to trade today. Let's say today is your day off and you are prepared to sit down and spend 6 to 8 or 10 or 12 hours day trading. Well, then trade off of your 5-minute, but don't forget to give a quick look at the 30-minute, the 1 hour of the same pair, right? Or whatever it is that you're trading. And then take a quick look at the 2 hour or the 4 hour as well. Sometimes I find opportunities where, and there was a video that I made just about a month and a half ago where price was dropping through support and it was kind of choppy. And I went through, the 30-minute, I went through the 1 hour chart. It was still a little bit choppy. And then I switched to the 4 hour chart, and it stopped right at an old 4 hour low, and it reversed, gave me a reversal candle pattern. I was tracking all of this with the volume that I had, and then I found my point and figure entry. And of course, you don't need all of that to determine some of the information that I'm talking about as far as these highs and these lows and these reversals. But again, the key point here is to don't fall into that, that rhythm and that pattern of just trading off of one time frame. Take a look at the 30-minute, take a look at the 1 hour. It's not guaranteed that every time you do that something clear is going to pop up on the 30-minute or the 1 hour chart. But if you do it often enough, it's going to eventually pop up, and it's going to be really obvious, and you're going to see it. It's going to stand right out in front of you, and it's going to give you a much better trade opportunity instead of just firing off trades off of a 5-minute and little tiny trend line breaks and wondering why your account isn't growing. You've got to find the right trades, trade with the smart money. You're going to make more money on these trades, and you're going to have fewer losing trades.